Welcome back to another PCE inflation report. Today we'll be covering, well, that inflation report. We'll expect it to be, unfortunately, somewhat similar to the CPI report. So I'm not sure which way we'll really get surprised here, but CPI is really interesting when it comes to PCE because it donates so many of the calculations that are used for how PCE is designed or how we come up with PCE that I'll be really interested to see how housing might actually end up being somewhat different with the PCE release here in about 3 minutes. PCE is also put together by the Bureau of Labor Statistics. If you really cared, they've got about a 69-page long document on how they calculate it. Not that I really think that would really be useful in sort of predicting CPI, unless you wanted to sit here all day long and try to extract everything from CPI and figure it out. But it does sort of make me wonder how, like, why do we have two of these? But they do have different weights. At the end of the day, they do have different weights. You look at, for example, housing only overall as a weight has about a 25% weight, whereas in PCE, whereas in CPI, it's closer to 34%. So we know there are those initial weight differences. Question then is, when some of the weights change over at CPI, do they change over at PCE as well? Who knows? So that'll be interesting. But I'll take a look at this, for example. For tenant-occupied permanent site dwellings, the benchmark estimates of rent per unit are based on the cost of housing data provided by rent class. The charges for utility, energy, gas, electricity, fuel, water, sewer maintenance, that must be subtracted from the rent estimate as follows. I mean, this is 69 pages of that kind of language. The PCE estimates for each type of energy are allocated between tenant-occupied and owner-occupied. Oh boy, like, whatever. That's it. I think if you were, quite frankly, an economist who wanted to sit here and run your own spreadsheet at Morgan Stanley or whatever, you'd be able to maybe pull this off. But then again, how rough people's estimates seem to be when it comes down to actually predicting this, I think we'll just be better off waiting to see what happens. But anyway, so technically PCE should have a little bit of a lower weight, but I'm not holding my breath. So as far as what we're expecting, we're looking for that 0.4 on, oh, interesting. They just, there, okay, yeah, there it is. 0.4 on the core month-over-month read, and then the year-over-year core, we're looking at 2.8 with month-over-month non-core 0.3. So we'll see. That'll be out in about 1 minute. So we'll have that shortly. Okay, with that, we've got the Qs down about 26 basis points here in the pre-market. I think there are expectations that people yesterday and funds were selling yesterday before the inflation data because they kind of expect it to be maybe bad news, just like what we had in the January read for CPI. So you get a little bit of pre-sell, so you can go buy the dip the next day. Makes sense. Usually before we get big data sets, we end up having somewhat of a sell down in markets. Though Bitcoin didn't really seem to care. Bitcoin was kicking butt yesterday, so good for it. A lot of supply. We'll talk about that. A lot to talk about on EHAC actually as well. But here we go. Let's get it. Initial claims, by the way, 215 versus 210. A little higher than expected, and continuing claims a little higher than expected. Still waiting here for the PCE figures to come in. 13 seconds here after the hour. Waiting a little bit longer. Come on. Where's that PCE figure? Okay, personal income comes in at 1% versus 0.4. And the PCE match on month-over-month, match on month-over-month, full match. Everything matches on PCE, just as expected, with personal income coming in hotter than expected. So look at that. You could clearly see the Qs are happy about this match. It is not some form of weird, explosive runaway beat again. PCE matches expectations. No shocker there. I think folks were really thinking there might be another rug pull. Let's listen into Santoli give his explanation.
January, this number once again could take you back to July 21. That is a whopper of a spending jump, or income jump, excuse me. On spending, up 0.2 exactly as expected. Real spending goes negative when adjusted for inflation. That's down 0.1%, and down 0.1% equals what we had in August of last year. To find a lower number, you have to go to March of 2023. Now, let's get into it. The deflator, personal consumption deflator, month over month, up 0.3%, exactly as expected. In the rearview mirror, 0.2 becomes 0.1. Now, on the 310 side, that's the highest level since September of last year, something to pay attention to. Now, let's go back to the deflator, but this time the core, okay? And let's go, let's go year over year on the deflator, and that's going to be up 2.4%, exactly as expected. 2.6 in the rearview mirror, so making very good progress. This is the lowest level since February of 21. Now, month over month, core deflator up 0.4%, exactly as expected. And 0.4%, though, follows up 0.1%, so up 0.4%.
Yeah, those revisions did pop in. Both month-over-month figures get dropped about 1.1, both month-over-month, the core and non-core for the for the December read.
Because we take these things out a couple of digits. And finally, year-over-year core deflator, in my opinion, one of the more important numbers, 2.8. Last, what we expected, 2.9 last time, so we've made progress. Now, here's something interesting. This is my favorite calculation. This is now the 12th consecutive month that this has moved lower than the previous month, and that is indeed a very good thing, of course. Now, 2.8% is good, but consider this. Pre-COVID in March of 2020, this was 1.5%, just to give some context. Now, what have yields done? They've dropped precipitously here from basically 430 all the way down to 427. No, I'm being a bit facetious.
Yeah, no, that's not much of a big drop at all. That's why he's always happy when those bond yields go up. The bond yields are barely moving. You're at like 4.28 on the 10-year. And I always like listening to him because I think he has a little bit more of a bearish tilt when it comes to inflation. And it's interesting, this idea that when we compare to 2019, in 2019 it was 1.5. Yeah, in 2019, in the decade prior, we were essentially fighting deflation. It was crazy. Remember the Fed was in a position of considering lowering the inflation target from 2% to 1.75%. Somewhat remarkable. So personal income and PCE outlays, all that good stuff. We've got the full doc as well. So let's take a peek at it here just to see if we can see anything juicy. But given that we have a match across the board, it does seem like markets themselves are somewhat happy about this. We went from negative 26 basis points on the Qs here to positive 28, 29 here. I think folks were clearly the market, given that we just met expectations with the exception of personal income, clearly the market here was expecting some form of pain to come out of this PCE report. So we'll watch here. But it looks like Enphase up 3% now in pre-market. Even NVIDIA moving up 1% in pre-market. Tesla's up 1% in pre-market. What's actually down? Probably just Snowflake from yesterday. Yeah, Snowflake's down 22%. Lunar continues its bleed, its momentum bleed. Not a surprise as momentum stocks become non-momentum stocks. Guess what happens? They bleed. So that is expected. And get a couple other reds here, but no particular pattern. We'll look at Snowflake in a moment, but first, let's just look at the actual sheet. Personal income increased 233.7 billies. That's a 1% at a monthly rate in January, according to estimates released today from the Bureau of Economic Analysis. We've got PCE. We've kind of already read that across the board, and we had matches on these. Let's see if we could see any particular kind of PCE commentary here. Personal consumption. Okay, $121 billion increase in spending for services. That was partially offset by a $77 billion decrease in spending for goods. Largest contributor. Oh, look at this. There we go, yet again. Largest contributor to the increase. This is to the increase, not to the total number. It's to why it's rising. And that's important. That's a difference. Because when I say housing, of course, most of your income generally is going to go towards putting a roof over your head. And so now we're just talking about the largest increase. Housing, there it is again, insurance, as well as financial services and healthcare. Healthcare and insurance just love lagging. But again, sort of like waiting for costs to go up and then reacting. Oh my goodness, costs have gone up. What are we going to do? Well, we're going to raise prices. Within goods, the leading contributors to the decrease were motor vehicles, as well as parts, led by new light trucks. Wonder if that's like the Cybertruck. And non-durables, led by prescription drugs. That's interesting. Okay, personal outlays we've got here. Prices. This breaks us down a little bit on the actual categories in terms of how prices are moving. Let's see here. Updates. No real major revisions we've got here. Touched on some of the month-over-month revisions, and that's about it. So PCE report, pretty benign here. Let's see if they've got anything else to yap about. Who's this guy? Is that Geithner?
If that's the case, Becky, you will see income over time be revised down. It's a much different picture. On March 28th, we get the revision to, or the data on the gross domestic income for the fourth quarter. That number has been significantly weaker than GDP. And in July, we'll get the annual benchmark revision. My guess is as we get to March and then into July, we're going to find an economy that is a lot weaker than people think. And I would argue this is very consistent with consumer sentiment, which, while it is up sharply from its low, is still consistent with recession.
Ben, you have any thoughts on that? Because the consumer has...
Interesting recession talk. I want to keep hearing about this, but somebody here is saying the Cybertruck is heavy. It may seem like it's heavy, but it is still classified as a light truck. A heavy truck is anything over 8,500 pounds. A light truck, like the Cybertruck, would be under 8,500 pounds. Like Cybertruck's like 6,600.
Yeah, exactly. I mean, that's the key thing to watch is the strength of the U.S. consumer. U.S. consumption has driven a fairly robust recovery. We've had 6 straight quarters of positive growth driven by consumption. I mean, my take is that it's being driven by 2 things. One is a red-hot labor market and rising real wages, which has put money immediately in people's pockets to continue spending, and they have. And the second has been, and this is a little underappreciated, we've experienced a wealth boom in this country. The S&P is up 20% over the last year. The flip side to rising housing prices is higher housing wealth. That's a good news for homeowners. So I think the U.S. consumer, my take is the U.S. consumer will likely continue the robust spending that we've seen over the past couple of years.
Okay, so you and Joe don't agree on this. You don't think that you're going to see some sort of turn when the...
Has anybody seen huge crash videos paid by sponsors? I've seen that.
Looking at around 2% growth for Q1. Atlanta Fed now is slightly higher, around 3%. Until you show me consistent patterns of the U.S. consumer slowing down, I'm just going to look to the recent historical trends.
Steve, what do you think just about the strength of the consumer right now?
I kind of agree that I wouldn't jump off of this number and say now is the time to sort of give up the idea that the consumer is going to remain strong here. Always listen to Joe Livornia and his outlook there. If indeed employment is weaker than we believe, then that's a reason to be concerned. I will point out, and I wonder what Joe thinks of this, I have wages up a very healthy 0.4% in this report here, which to me has been the thing that many economists have, I think, overlooked, in the idea that people have thought all of the spending came from that stimulus that was out there. I tended to think that at least a good chunk of it has come from the idea that wages have been decent and employment has been relatively strong. So long as that remains, I would be upbeat on the consumer.
Yeah, that's a great point of view, just the idea that the consumer hasn't really lost their jobs yet. I've personally thought that one of the biggest concerns we faced is an unemployment recession, but it was just wild. We look at this almost daily. I feel like we try to find out what's actually been going on with layoffs, and are we seeing a worsening of layoffs? And when we jump in over here, we can see total tech layoffs at least since COVID. This might not be all industries, given that it does say tech layoffs. But in terms of tech layoffs, if anything, we're just petering out over here with actual layoffs. Now, today's leap year, so we're pretty much done with layoffs over here. You're at 15,000 in February per tech, per this statistic. And that's almost a third of what we had last February, and certainly doesn't compare at all to some of the larger candles we've got here. Now, again, those are just surveys of tech layoffs. It might not be the best data set, but it does kind of give us an idea that, okay, maybe we don't have as much pain in the layoff sector as we had last year, and instead, what the question is of what keeps the economy going will end up just being, are consumers going to keep spending? So far, the answer to that seems to be yes. But again, it feels like, and that's what's annoying, is it feels like it has to end at some point, the amount of spending. A lot of the spending, as many think, is based on what we've seen with, here's another layoff chart I wanted to pull up. And this has to do with warn notices, larger companies sending warn notices that, hey, you know, there are going to be some layoffs coming. It's right here. When it comes to the BNPLs and sort of the borrowing, credit, we know credit has risen substantially, but and private credit is now outstanding at a higher rate of what we've had before COVID. But how long can that keep going, right? That just because the credit has now extended higher than what we've had doesn't necessarily mean, you know, everything needs to stop, crash and burn right away. It makes you wonder how long things can remain unsustainable. That's always the funny thing. Like, it's kind of like when you look at a stock, you're like, I know it's overvalued. Or you look at, you know, another situation. I know it's I know there's a mistake. Whatever. The question then becomes, okay, well, when is the market actually going to realize and care? That could be a little frustrating, challenging sometimes. But anyway, here, warn notices. You can see that spike there in 2022. Obviously, nothing holds a candle to what we saw during COVID. That makes sense. But what it does do is show us that we're even down from the numbers we had in 2022, 2023. And it doesn't seem like we are continuing to trend into real pain there. Although, I suppose we shall see. That's always the reality, though. It's going to take some time to figure it all out. All right, so I wanted to also look at Snowflake. Snowflake had some numbers yesterday. I was also already going through some of these figures here, and I'll tell you their balance sheet is just absolutely phenomenal. Let me find their balance sheet here. Okay, hold on a sec. Yesterday I was annotating it. Okay, I don't know what happened to my annotations. Ah, I remember. It was a different iPad, so it just needs to sync over. Okay, yeah, no problem. I'll grab that. 1 second. Solutions. It's on the bigger iPad. Who doesn't like it bigger? Okay. Is this it? Oh, yeah, here we go. Okay. So their balance sheet, look at this. This I thought was incredible. So this is their balance sheet. 2024, you've got cash and short-term sitting at about $3.8 billion of cash and short-term investments. Really, that's a lot of money, $3.8 billion. And when you look at their payables, you've got maybe 500. You know, you look for sort of a longer-term liabilities. You don't really find any other than just, you know, maybe 33 million. So you're really taking off about 500 off of this. You're sitting about you're sitting at over $3 billion of free cash available for this company. That's incredible. And even though they're losing money, a chunk of that is their stock-based comp. And so they've actually got cash flow of about $344 million in 3 months. That's just a 3-month period of time. So in a 3-month period of time, you've got a company like Snowflake generating over $300 million. That's adding 1.3, 1.4-ish billion dollars to their balance sheet every year, despite the fact that they're losing $170 million. Now, I always think that's kind of funny. And people always wonder, well, where does that come from? Like, how is it possible that the company can lose money, right? We've got operating income here of $532 million, growing from 383 at 39%, and operating expenses growing at about 29.6%, 808 versus 623. How is it possible that when you're spending more than you're making, you can actually have your cash flow go up? Well, it's because companies like this with these losses are financed by none other than these folks, your shareholder counts. So the shareholders get fewer earnings, fewer future earnings, you get more dilution. In fact, if you just look here, they issued 10 million more shares, roughly. I guess if I was going to round, it'd be more fair to go with about 9 million more shares. So they issued about 9 million more shares. Well, think about it. Let's say they issued those at about $200, okay? So you issue those at about $200 over the year. That would work out to $1.8 billion. So just this share count number changing right here, which nobody ever pays attention to, is about 1.8 billion at $200 a share. So it gives you a little bit of an idea who's really paying for the money-losing companies? Shareholders. And so I think that's why, even though the numbers weren't that bad at Snowflake, I think what just pisses people off is the dilutiveness of a money-losing company, quite frankly, making their investors pay for these annual losses. But stock still ran up. I mean, going down even 20% brings us to about the 180 range. It can be a fat red candlestick and go right back down to here, levels we were at in December, or where we stabled out previously. Stabled out previously in the 180s, and we've been lower than that. Let's go to the week chart here. Yeah, here's Snowflake over time. So getting a nice little reset, almost to that 100-day moving average. So, oh well. What's wild is they do still make money. They're still clearly a very strong product. Here are the Qs, by the way. Still clearly a strong product. They clearly make money. They are obviously a company that is capable of providing a product that people like and people and companies use. A lot of Fortune 500 companies. I want to say they've got somewhere around 600 of Fortune 2000 companies. So you've got a lot of big companies that use them. So hopefully they continue to provide some good value, but I guess it's just still costing a lot of salary money to make it actually happen. Let's listen in here for a moment.
I think that some people have a view that EVs are not having as big a take-up as you might imagine, is that the product itself is not that great.
Yeah, I mean, look, I own 2 Teslas. I bought them early, and they're just, for me, they're not my day-to-day driver, because if I need to go 2 or 3 cities away, I don't want to worry myself about where the next charger is. And when even in Palo Alto, where I had one, you have to sit at the shopping center in Palo Alto for half an hour, and you have to wait in line for a charger.
Right.
Like, it's not like going to the gas station for 2 minutes and filling up and leaving. So, there are only specific use cases that work. And if you're just driving in a short distance and plugging it home, I get it. But it can't be your daily driver, and especially in places that have more rural areas. So
do you think that the whole EV thing is just a fallacy?
What? Say again?
That the EV, the market for EVs, over call it even the next 10 years, is a fallacy, because you will never get. It is unlikely that you're going to get the battery to really extend over the next 10 years in a way that may solve the problem you're talking about.
Correct. I mean, in my case, the stated mileage would say 232 on a full charge. I could get about 100 miles.
Really?
So that was early. Now they've gotten better since then, but I won't buy another one. I won't buy another one probably as long as I live. So
really?
Yeah, because I drive.
I wonder what their holdings are, these folks. They sound so bearish on Tesla. Oh, I go 2 or 3 cities away in Palo Alto. I'd have to sit in a supermarket to charge. You got 2 or 3 cities away in NorCal, not having to charge at home.
Nice or conciliatory towards the United States. I don't think you could come up with anything. So I'm not going to ask you that. Andrew, this is in the Journal once again, but it's the former science editor of the New York Times.
Okay.
Who's saying that not only do documents now show that the virus, COVID, came from the lab, but it was, I don't know how this is new, but the laboratory actually developed.
Oh, this is the Wall Street Journal piece. I saw that yesterday as well. It's actually on the Freedom of Information Act, stuff we already covered yesterday, or a few months ago.
To test these things. Now, it's still a leap to say that it was released on purpose and sent to the rest of the world on purpose, but are we ever headed there?
Look, okay, I'll give you a theory I have. It's really simple.
You know, honestly, I don't even really care about this guy's theories. I think he's clearly positioned in a single mindset. So, bye. Okay, so 62 bips here on the Qs. We've got the Googs 42. Okay, so it looks like most things are going to try to be green today. You've got less than a page here of red. Look at that. The only things red are really, what do we got? Snowflake, Lunar, Beyond Meat, VinFast, Sunrun. A trade desk over here at about negative 35 bips. Domino's because we ordered Papa John's yesterday. I hate the Papa John's. I don't know why. Lauren says the kids ask for Papa John's, and I guess they're in charge. But they're kind of like oh yeah, we're going to have the pizza ready at 5. Like, you could schedule, when do you want your pizza? So we've scheduled it before for 5:30, shows up at 6:30. Last time we scheduled, okay, it'll be ready at 5:30. Cool. Shows up at 5:07. And we're like, what the hell? So what's the point of scheduling if you're just going to do it on your time? I don't know. I hate Papa John's. Domino's, on the other hand, they're great. So I'm going to have a talk with Jack and Max about the pains of Papa John's. Anyway, let's see what the suits are saying in reaction to PCE. All right, PCE, we've got super core services inflation, highest since 2021. Okay, so now the super core numbers are out. The inflation figures look pretty much bang in line with expectations at first glance. Let's see here. Where is super core? On the other hand, personal income was much higher. That's fine. They don't even mention super core. Inflation figures look pretty much bang in line with expectations. Monthly change was revised lower. On the other hand, personal income was much higher than expected, right? So where's the super core part? Oh, here. Super core services X housing rose 0.6. Strongest gain since December. Yeah, it's probably based heavily on what we saw with CPI as well. CPI was based on, I want to say it was vet services, motor vehicle insurance, and hospitals, if I remember right. I can pull it. But yeah, there was quite a bit of a pop there on Supercore and CPI as well. And a lot of those figures are borrowed, unfortunately, from CPI. So you're kind of having the same kind of complaint twice with it. Is it... Let's see here. This was January CPI. Oh, yeah, here it is. So right here, we mentioned that it was housing, vet services, vehicle insurance, and Medicare services. That's what really drove up your super core in the last CPI report, which we got about 2 weeks ago. So... All right, traders in line with PCE data see it as a dovish surprise. I guess people were thinking it was going to be worse, which that again explains what we've seen in at least the stock market. Bond market, 4.26, down a bit for the day. I mean, barely a movement here on the bond market, which that's going to mean our 10-2 is going to be pretty stable, or 2-10s. And if we look at break-evens, which we'll do as well here, 5-year break, let's see what we got. 5-year break, if I remember correctly, the last time we looked was about 2.39. Now we're sitting at 2.44, so it's up. 2s, 10s, 38 basis points of inversion. And we go to the 5-year forward. So the 5-year break-even has really shot up. I mean, since about December, we were sitting about 2.08. straight up from there to about 2.44, which is the highest level we had in October. And then the highest level we had, and then we hadn't seen that sort of level since April of 2023. So we were way lower on inflation expectations for May, June, July, August, December, January. So inflation break-evens have definitely popped off a little bit on these higher yields. 5-year forward, you're seeing the same thing. You're sitting at about 2.24, which certainly isn't as high as some of the previous spikes that we've had, but also slightly trending up here over the last 2 months. Nowhere near as much over as the next 5. I guess Birkenstock beat. Let's take a quick peek here. And then we can also look at Salesforce. Birkenstock, they're down about 4% despite their beat. The big question, though, is regarding these guides that we had. We just looked at Salesforce. We just looked at Snowflake, and we're about to look at Salesforce. It seemed like the guides weren't that far off. It was just a tiny, like a 3% miss on Snowflake guide. Let me see. That's what when I was looking at it yesterday. You had a Google exec come over to Snowflake as CEO, who has the same last name as Vivek, but apparently no relation. Sridhar Ramaswamy. Then you've got basically all the Q4 numbers beat. Revenue, diluted EPS, product revenue. Q1 guide was 7,475. That's 747.5 million, and the guide or the expectation was 769.5. So you missed by about 20 there. So when I ran this yesterday, it looked like we were missing by about 3%. Let me just double check my math. 769.5. Yeah, 2.9%. So 2.9% miss, and the stock's down like 22%. And a little bit lower 2020, fiscal year guide going forward. 3.25 billion versus the 3.46 expected. Maybe that's because when you look at a company like Snowflake, what you're really trying to do is you're trying to find out when are they ever going to be profitable. And so what you have people do is you look over here and you just sort of extrapolate and say, okay, how long of these numbers am I going to have to wait? Like, how long am I going to have losses before we're actually going to go profitable? I'll pull up the expectations from Wall Street quickly. They are, on an adjusted basis, they're looking at profitability right away, but I wonder when we'd get to the non-adjusted basis. Unless they expect them to be profitable this year. Maybe that's why that pushed them back a little bit. I'll have to dive into that a little bit more. But anyway, we'll go to quickly Salesforce. Salesforce, Q4, beat, match. You pretty much beat and matched on Q4. So what was the forecast? Q1 adjusted EPS. That's a beat. 2025 revenue. Oh, there we go. There's the miss. 2025, so their next fiscal year revenue, 37.7 billion versus the so 37.85 versus 38.62. So you missed by 2%. 2% miss on Salesforce. And I think people are suggesting, oh no, this is the sign of weaker AI demand. No. I don't know. Salesforce just went positive. Didn't seem like that big of a deal. 2% miss over here. And the 3% miss on Snowflake, I think it's just exacerbated by the fact that they are still burning money. At least shareholder money for the time being, since they are increasing their cashola. All right. So what else? Then we've got here. Oh yeah, we could look at Okta. Okta had a pretty incredible beat and pretty incredible move there. So we'll take a peek at that. Markets are so stupid, says somebody in the chat. Hell yeah. Duolingo. Yeah, we looked into them for a while there. They just print money. Duolingo. Let's see how they've been doing. Oh, up 22%. Wow. Look at that. So this is a company that they've been on a tear, and it looks like their tear is going to bring them right back to virtually all-time highs. Let's see here. Duolingo. This is the iPhone app. These folks just print dollar hollers. So let's see here. Individual company news. Oh yeah. See, they beat expectations by about $23 million on top of the 698. So see, they beat by about 3.2% for their year, and they expect their daily active user growth in Q1 to be around 55%. So still growing like crazy. Obviously slowing slightly, but they're also, of course, they're adding AI. New AI content. I mean, I don't blame that at all. Good for them. Okay, what about Okta? And it's kind of like adapt or die at this point. Okta. Whoa, big beat here. Q1 adjusted expected to be about 54.5 cents versus 42 expected. Revenue, slight beat. And Q1 revenue, slight beat. So a slight beat on the Q1 revenue. The forecast is good. Yeah, there's nothing not to really like over at Okta. And I'm pretty sure they're moving pretty nicely as well. Let's see here. Let's go add Okta here. There we go. Yep, another 20%er. That seems to be the number of movement you're going to get. Okta, Duolingo, C3AI. I hate this company, but they still up 19%. And drop that to the other side. Snowflake, 22%. So, and again, barely anything red here. I mean, on our chart here, what, maybe 8 or 9 that are actually red? Kind of nominal. You know, even Trade Desk got out of there. It's like, no thanks. I'm not going to be red. No thanks. Where'd Trade Desk go? Let's find it. Trade Desk. Up 1%. They were down about 30 bips. All right. So, let's see. Okay, Argentina expecting a potential IMF deal. Talked about super core services. Public service announcement on inflation break-evens. Inflation is once again the topic. Yeah, okay. A couple of people asked about the sharp rise in short-dated U.S. inflation break-evens. Blah, blah, blah. Oh, these are like going out to the one-year inflation break-evens. One-year swaps have nudged higher this year. They're nowhere near the apparent level of Treasury break-evens. Let's see here. So we got information sort of all over the place here. Yeah, I don't like going down to the 1 year, mostly just because it seems to be a little bit more unpredictable. But I guess you got some spiking 1 year break-even expectations. 1 year is almost always going to roughly align with I mean, you're going to get so much closer to where the Fed's rate is right now. Let's see what the 1 year Treasury is right now. Treasury. Let's see here. Yeah, the 1 year is 5% right now, and the FOMC rate is what, 5.25. So that makes sense. Okay, and that's their range anyway. Well, rather 5.25 makes up part of their range. Okay, what else? Then we will go to, let's take a peek at how BTC is moving. I threw a little bit of BTC news up there on ehack.com. Yeah, we're about 63,000 right now. Let's take a peek at it. Thank you to whoever shouted out the little oopsie there on one of the halvening pieces of data. That is fixed. Appreciate it. But take a peek here. We got a housing section here. I threw in a Bitcoin section here. Look at the trade volumes this week on the ETFs. The ETFs on average are up 210% in trading volume, which is wild. So pretty big increase there. The largest 3 new ETFs by volume are IROC. It may as well be IROC. It's BlackRock's. It's IBIT, and then the Fidelity Bitcoin ETF, and then ARKs. But the disparity is huge. I mean, you're talking $3.3 billion for IBIT, 1.4 for Fidelity, and 447 million for ARK. 447 million for ARK, and I think they all have fee waivers for now. But if you look at the fee on the left side, you'll see ARK after the fee waiver is expected to be 21 basis points. 21 basis points works out to about $940,000 a year. That's pretty impressive. Those are some pretty good dollar hollers there. So, good job, Kathy. Yeah, and then what's also interesting is, we can always look at the Bitcoin halving as what happened before and after with Bitcoin prices. But what's so remarkable about it is Bitcoin's in its 14 years has basically only gone up. So one of the challenges with looking at this sort of before and after halving chart, which I found, is that it doesn't really matter, whether the halving happened or not. Or halving. Some people call it the event is the halvening, but you're actually getting a reward of about half, so it should be halving, whatever. But anyway, it doesn't really matter where you really look. The longer term trajectory has just been up. So somewhat interesting. Then we've got Morgan Stanley thinking about adding Bitcoin to their platform. So you got some housing talk over here as well. Worth taking a peek about inventory starting to loosen again for new and existing homes. Well, we expect that going into April and May. I wrote a little note here as well that we expect that for house hack. Remember, we've got the Reg D fundraise going on, as well as the warrant call. Once we work out our cycles, which we expect to this year, might not have to fundraise ever again for house hack. So take a look at that if you're interested. Go to househack.com/2024 and read the PPM there. As far as if you look at existing home sales, you can see these existing home sales are back as low as the levels we saw in 2010 and 11 in terms of how many homes are selling. I wrote a little note here. That's when I started in the biz, and 2010 I remember end of 2010, beginning of 2011. I remember you've got so much inventory on the markets. There's just nothing but pure saturation from a real estate point of view. There's so many choices, but nobody was buying. Today, it's like people want inventory, but you can't because there is none. Such a very interesting difference from inventory. That will be going from such high levels then to low levels in like 2013, but high transactions because a lot more is turning, to where we sit now, which is just low levels of inventory and people wanting to transact, but they can't. New home sales, more like 2016, 17, 18 levels. Rising real incomes will continue to support stocks even as concerns of interest rates stay elevated. Forget savings. Updating this real spike of income, even when you subtract inflation, you've got some positivity here. Yeah, I think Rick made a little oopsies when he said that real incomes were negative when you subtract inflation, because the income numbers are, I believe, quarterly, whereas the inflation data, the year-over-year data, is annual. So I look at personal income. Let me see here. Is it? Oh, it's for the month, actually. Oh, that's surprising. Yeah, personal income for the month up 1%. Oh, yeah, that's remarkable. Inflation's less than a third of that on a monthly basis. So yeah, you're way outpacing inflation there with that personal income boost. How true it is, TBD, but, see. Let's see here. Oh, this is interesting. BLS. Claims are still very low by historical standards. We expect that to change soon. The WARN numbers capturing advance notice of plant closures and mass layoffs have jumped recently and point to initial claims rising significantly over the next few months, says an individual, looks like analyst here. And that's, okay, here, I'll pull this screenshot up so you can see what I'm looking at. WARN notices. Now, this is not going to be just tech. Some of the downsides of the layoff trackers is they're heavily focused on just tech. This is the chart. There we go. For all, this is a compilation here of all. You can see the rightmost is January. I'm covering that right here. So you've got January right here. And when you look at after January, we've got this, or in January rather, we've got this spike that really, we haven't seen that high of a spike since January of last year. But then again, January of last year was also substantially higher than what we had before that. So January is the month to see sort of this WARN data. Usually you get a 60-day notice with the WARN data, if I'm correct. WARN notice days. Yeah, 60-day notice requirement. So if you got notice in January, you'd expect this to start showing up as an unemployment claim in March and April. Now, see, that's interesting, because if you do get a spike of claims in March and April, does it then potentially lead the Fed to be a little bit more interested in cutting in May? I don't think so. Certainly not what markets expect right now. I want to say we've almost fully priced out May, but I'll look. There's still a 21.2% chance of a cut in May. All right, so there's still hope. The hope is still alive. Interesting. All right, let's listen in over here for a moment.
That's not happening. Do you think it's fine, Paragon? I like that. All right, we'll get to Paramount later. Let's talk Salesforce.
Now, thank you, because this is one of those incredible stories where Mark Benioff comes on red hot, as you'll see when we play the clip.
Yes.
And then his COO comes on and says, it's just okay. I'm going to take Mark's view as the CEO as more important than the COO's. COO's talking about, like, maybe we have green shoots. Mark says it's 180 degrees from when it was not good.
All right, let's
Mark
listen.
is the most. Let's
listen to Benioff's view on the quarter.
The stock is right to be up.
We just finished up a year at almost $35 billion in revenue, and now we see us moving forward as the third largest software company in the world, delivering tremendous amounts of customer success. And Jim, it's really about, exactly like you said, customers, giving them what they need right now, and that is the ability to manage this huge amounts of data that they need to deliver high-quality artificial intelligence.
I have this one cold, man.
I don't know what you're doing.
No, I'm getting my.
Okay, and not everybody's a believer. I mean, Bernstein is not particularly
cut
positive.
me a break, Bernstein. When you get on board, the free cash flow here was updated. That's the real number. It's up 27%. The fact that he got stock, everyone's worried about this stock being given out.
Stock-based comp.
Yes, he's cutting that down and put a dividend in, just like Mark Zuckerberg did. The gold is the data in this case. In other words, he actually referenced Jensen. Of course, if you don't reference Jensen, get the hell out of the room, okay? But I thought that what Mark was saying was the data cloud is going at a level that I can't believe with higher margins. This quarter was exceptional, and I think that 7 trillion records this quarter in just the data cloud alone. Unbelievable. AI transformation.
The margins continue to be strong, is what you're saying.
I love
and
margins.
Listen, it's the same thesis, frankly, that Jeff Smith had some time back when he was the first of the activists to get in there.
Yes.
Pressuring the company. This was the fall of 23.
Mark embraced the activists as they'd never been embraced.
And he continues to talk about things such as, when he tweets, he talks about revenue and margin trajectory in a way that he perhaps hadn't as much in the past.
Exactly. Great.
So you've got a sticky business with pricing power and margins that continue to improve. That said, Bernstein, for its part, and I know you discount this to a certain extent, says, they just said the overall roughly 10% subscription revenue growth, total revenue growth, 200 basis point margin improvement, a bit lower than they'd expected.
That's just, I don't know what they were doing, because they were obviously using a number that they wanted the company to fail. I'm tired of that from Wall Street. And David,
I love, Jim always gets so defensive about the CEOs. I think it's because he loves having the interviews with them, which, I guess you can't blame it. You have interviews with the CEOs. I'm sure there's this point of, hey, these are nice people, and then sort of coming into their defense in the morning. That almost always seems to be the consistent theme there. Maybe Jim should interview Boxable's CEO and see how he feels about them. Did you all see this? I never made a video about it, but maybe somebody can tell me if you see this. They after I did my video on Boxable, they decided to buy the patents they pretended they already had, because they were leasing the patents from basically their own shell company. And so when we exposed that, they ended up a few months later buying all of the patents for $30 million. So they basically bought from themselves with Boxable stock $30 million worth of what should have already been Boxable's patents. And these $30 million, the owners are like, oh yeah, we'll donate that to charity. Well, they don't say when. I mean, it could be like after they're dead. So it's like they don't care. Anyway, it's kind of comedy. I don't know if I've covered that yet. Maybe it deserves a little bit of a deeper video, but anyway. So let's see here. Somebody says, I remember Kramer pumping Lehman Brothers and other banks right before they went bankrupt. Oh, let's see. I hate seeing people licking the tips of their fingers in order to go through pages. What are pages? Like on an iPad? Like scrolling? I'm kidding. Bloomberg, please. I'd rather have Bloomberg. Oh, let me see if they're even up. They're on commercial a lot, so I often don't leave it on Bloomberg, and their bell is a little more delayed. So, but let's see what they're saying. Let's see commercial. Yeah, classic. Darn them. So let's see here. Okay. Oh, when are Costco's earnings? Let's see here. Do I hear that Sam Bankman-Fried is pitching Solana? That doesn't surprise me. I mean, when people know what you're in there for, they're going to ask you questions about it, and if they could extract value for it from you, it's actually a form of currency where, to some extent, if you could provide some form of insight and give folks some hope, for when they get out of jail or prison or wherever they are, that does become somewhat useful. Costco's earnings are in about 8 days. Yeah, March 7th. Let's see here. Yeah, actually, I am short ARM because of the lockup expiring soon. I think somebody else was asking why. Yeah, I'm mostly just playing the lockup game. I think ARM's actually up today. It was down both of the last 2 days, but I do think it, it has a strong fall, much more than what we've seen so far. 7% or whatever, which is nice. But I think we've got a larger move ahead of us for ARM. To the downside, again, because of the lockup expiration coming about March 12th, 90%, 90.1% of float owned by SoftBank, the expectation of the lockup, and we'll see. But the PCE numbers this morning helped prop everything up. I think they went from like negative 1% this morning to I think they're up like 1.5% right now, 2% right now. Yeah, so little jump there right on that PCE data. I wasn't expecting them to be that sensitive to the inflation data, but then again, everything kind of was. So jump on into Qs, for example. Yeah, we're up 60 bips here. So Dell, get ready to moon. That's entirely possible. I don't actually disagree with that. I think we were looking at them in the Course Member Live the other day. Oh, yeah, their next announcement's today at the close. Oh, that'll be really entertaining. Now, the one thing is the market's already expecting a movement here. You've got implied one-day move of 9.16%. Their average implied move is 3.4%. So you're basically expecting 3x the volatility on a stock like Dell. So Dell Tech, yeah, but look at that. It's already done pretty substantially well, but still expecting that to move more. It's Celsius report this morning. Let's take a look at it. So if I go to Celsius, 17 cents, doesn't even provide an expectation, but it does on revenue, 347 versus 331. But it says revenue beat disappoints. Celsius holding slumps as magnitude of beat. Oh, the magnitude of beat wasn't good enough. I'll tell you, the stock market is like the most fussy thing ever. Wow, you beat. It wasn't big enough. It's kind of like what the stock market sounds like to me. It's like a really annoying, squeaky, like 10-year-old. It could have been better. Snowflake missed by 3%. You said miss. Oh, it's so annoying. But yeah, that's the market we get to play in. Hey, Enphase up 420. We'll just leave it there and look away. All right, ASML's still down about 21 bips, but we're on the way to 1,000 here. Look at that. When did we pick up this sucker? ASML was back in November 22. I want to say it was over here, like $600. That sucker's up 50%. Crazy. I mean, I know everything like chip and chip adjacent blew up from that time frame. You know, percentage-wise, Nvidia's up a lot more than that. Buying it for like 150 or something back then. So, you know, it's up like 4x versus the 50% here at ASML, but still, it's still good, man. All right. 10 minutes to the bell. Next. All right. So, what do we got here? Wall Street gets relief after inflation report. Right next to the headline, Fed's preferred inflation metric increases by most in a year. I guess people just thought it was worse. AI guides rocket strikes in new era of global warfare. Right. Dozen feared dead after violence near aid trucks in Gaza. That's just terrible. Okay. What is this? The message in Bezos and Zuck stock sales. S&P at all-time high. Bezos sells $9 billion. Zuck sells $850 million. This person is making the argument that these are not ominous sales. Instead, they are typical mid-cycle sales. Okay. Traders have come to extract signals from insider transactions for decades. In reality, public disclosures about insider activity are hardly a straightforward tell, and sales volumes are only foreboding if they're extreme. In addition to not wanting to go to jail, most executives want to avoid even the perception of mistreating minority shareholders by selling stock at market tops. Yeah, it just sometimes happens. Undoubtedly, there are always counterexamples. Yep, exactly. Yep. Kind of like when Elon started. Yep, they even give the example here. Elon giving, starting to dump Tesla shares to buy Twitter. It kind of makes you hate Twitter. I'm just kidding. I don't know. Maybe I'm not. That doesn't matter. And Bezos. Let's see. What's he doing? Zuck's apparently selling to fund philanthropy, so to speak. Bezos has been buying up real estate in South Florida. Lack of IPOs today. When a market is truly getting overheated, you often know it because the supply of IPOs surges, as was the case in the late 90s and 2021. But by deal value, the US is still only pricing in about $8 billion a month in IPOs, around half of what was typical in the pre-pandemic period. There may be some reasons for inactivity, including the hangover from all of the offerings of 3 years. No kidding. How interesting. Very interesting. Yeah, okay, slow IPO market. I don't know what that really has to do with like a Bezos, but whatever. All right, what do we got here?
And even negative aspects of some of the German economy. Thank you so much for joining me this morning. That is Gershon Distenfeld and Julia Coronado on the markets. Coming up, your morning calls, and a little bit later, we'll dig into the markets on the equity side with Binky Chadha. He joins me shortly. But the market implications from today's inflation report, that conversation ahead on the flows at Deutsche Bank on Bloomberg.
Music is always so schnazzy. But again, always on commercial. Let's see if Jimbo's on commercial. See, also on commercial. All of them. Like, how do you watch this crap? It's always on commercial. Well, we'll go look at we'll go play with the sticks ourselves then. All right. So how about this? We'll go look at what some of the Sudis have to say. All right. So, Sudis. What have you for us this morning? Today, leap year. Happy 29th? Okay. What is this? Barclays, as of this morning, what do they have to complain about? They have... these are some updates on individual companies. Advanced Auto Parts, on the right path, raising estimates. That's fine. Lowe's, what do they say? Lowe's, guidance largely as expected. Reasonable bar for recovery. These are kind of boring updates. Kind of have to go through 100 pages here to get a sentence of an update. Whatever. Okay. How about JPM? No, not much here either. It's too quiet. Oh, America's real estate. Okay, let's look at this. This could always be interesting. Goldman. Okay, here we go. Ew, a virtual... You know, that sounds like about the most boring thing that you could possibly ever attend. A virtual, like, Zoom commercial real estate event. Ugh, gosh, just give me the Pepto now to start vomiting. I vomit from Pepto-Bismol. I hate that stuff. But, gross. That just sounds so boring. Like, if I'm gonna do real estate, it's gotta be like an event. Like in-person fun. Not Zoom. Okay, save copy. Come on. Please to put where I want it to be. And then we'll take a peek at least what maybe some of their takeaways were here. If we can get the darn thing to save. There we go. Okay. All right. There we go. So, what did they say? Commercial real estate maturity, while not concerning. Our panelists were in agreement that while large commercial real estate maturity for 2024 is generally not overly concerning, 20% of 4.7 trillion in commercial mortgages outstanding are scheduled to mature in 2024. That sounds like a bad number. The amount has increased significantly by the quantum of extensions witnessed in 2023. Okay. While borrowers do not want to put in additional equity, the lenders do not want to take control of their assets either. Real estate markets close to the bottom, and interest in the space has picked up. Okay. Panelists agree that transactions in real estate markets would generally improve in 2024 from the bottom witnessed last year as financing conditions have improved, but noted there was strong elasticity associated with interest rates. Optimistic view for growth in the back half of the year. Yay. That makes sense. Path to recovery is likely to be a slow U-shape. I gotta believe that. No crazy like 2021 skyrocketing in real estate. Valuation is down 20% across real estate, better than 40% decline witnessed during the GFC. I think this would have to be commercial real estate, not residential, single family for sure. Office is still out of favor. Multifamily concerns are overblown. Really? Okay, well, I don't really care if they're overblown if sellers are willing to dump. I'll take it. Our panelists were in agreement that the issues witnessed at New York Community Bank were related to the rent control dynamics of their portfolio. Oh, how interesting. That's a new claim I haven't seen. Do not see broader risks associated with the asset class. Wow. Okay. Geography has something to do with near-term supply. Yeah, be careful. I kid you not. Be careful of the Sun Belt. Sun Belt. That's where you're getting serious oversupply. So be careful of that. OS, oversupply. Real estate looks better going forward. Hey, is this the perfect time to pitch? Check out househack.com/2024. Come invest with us. Okay, read the PPM over there. All right, what else? Is Doomberg back? No, they're not. They're showing you a foot rower. It just kills me. I don't want to see this. Okay, so we're going to go back? Nope, not yet. All right, fine. Lame. So 2 minutes to the bell. We'll switch to CNBC then, so we can actually get our bell. And Q's. Q. Here we go. 1 minute. 67 basis points. Look at that. Looks like we're going to rally into the open here. Okay. All right. So we are now 40 seconds away from the bell. We've got Celsius down 5.4. Snowflake's about to be less than 20% red. Birkenstock 6% red. There's not a lot of float outstanding for Birkenstock, so it doesn't take a lot of selling to push them down. Okta, Duolingo, C3AI. These folks doing well. All right, let's listen to the bell.
Agreement of a couple of years ago, and they had a big settlement. It was meant to be that there was going to be a compliance. And the question is, have they deceived the regulators? So, David, that is criminal. That is not civil. What I think is most interesting, the Justice Department looked into it. We always want to see where. The answer is it's the Seattle office. That's where they make the claim. And that's trouble. Because did someone deceive the FAA in the actual manufacturing of the plane?
Yeah. Boeing will be one of the names we keep an eye on. You can see the real-time exchange back at our headquarters, a lot more green on there.
And that's the PCE, which we should do.
Not a surprise. Here at the big board doing the honors, Rainier. It's a Timberland real estate investment.
Fairly interesting. Okay, so that is like 90% green, I want to say. You've got Tesla up about 126. Norwegian Cruise Lines up about 1. ARMS up 2. Damn it, get back in your hole. You were doing so well. Dropping for the last like 3 days. You've got Enphase up 4. Duolingo 18. C3AI Okta up there in the 20 range. Lemonade pops up again a little bit, around 4%. SolarEdge 3. Coinbase another 2.6, sitting at 206 now, with on the downside Snowflake back to negative 21. Celsius only down 2. Dell's down about 1 before earnings today. Earnings will be out later. 9% expected volatility. That's a lot for Dell. So we'll see what ends up happening. Take a peek at the Qs zoomed in to see how we're moving. The candle is up, sir. It is up. We've got Bitcoin at 63.3. Yeah, looking at, let's see how NVIDIA is moving in the first minute here. Looks like we're getting green candlesticks. Yeah, look at that. Pushing green on the candles. Then we go for trade desk, pushing slightly red. 80 bips now on the Qs. Nice. Great job. Okay. So, the next thing will be 10-year yield sitting at 4.25. See what they're complaining about here.
Perhaps, but they're so much larger. I mean,
right.
Japan's population declined, I think it was it 5% last year?
I know that our country is concerned about immigration, but you do need demographic growth in order to sustain a growth economy.
Yes.
The $36 trillion treasury market, huge debt. We can only grow our way out of it. We can't tax our way out of it.
We need as much economic growth and therefore higher revenues.
Without it, I mean,
with which to tax. The Japanese do not have significant immigration. So
no,
I mean,
they don't.
Longer term.
They've never liked immigration.
No.
They've been anti-immigration.
All right, this is boring. Okay, so we talked about PCE this morning. If you haven't seen it yet, it basically matched expectations, so it didn't come in as rough as folks thought it might. So that's now moved your markets broadly up 63.5, touching 63.5 on Bitcoin. And bond gains are now expected to potentially extend gains with what we're calling a month-end reallocation. Bond investors have had 3 times to react to inflation data even before today's core PCE deflator. But now the thought that bondholders might react to this super users BLS email we covered on the main channel yesterday, as well as the fact that you're at the end of the month, suggesting maybe there'll be some more bond buying today. More bond buying should lead prices of bonds to go up and yields to go down. We shall see if that ends up being likely throughout the day. Q's up 80 bips, still pretty stable. Looking for a little bit else here. Car rejections shock buyers with credit the tightest since 2000. Auto loan access declines. Credit availability the lowest since we've seen during the pandemic. Wow, that's quite interesting. Then we've got consumer. Let's see, consumer. This has to do with consumer distress in auto lending. Yeah. Yikes. You think so? I mean, that is another way you could end up actually crimping consumers is once you basically slow the flow. Oh, I like that phrase, slow the flow. Slow the flow of credit availability. It makes it harder to keep borrowing. And if you can't keep borrowing, you run out of money. And then you either got to start selling or figure out how to make some more dollar hollers or what. But it becomes problematic really fast. So let's see here. What else? What else is there? Jim suggesting U.S. should continue. Okay, border comments from Steve. Steve doesn't like Jimbo's comments on the border. Let's see here. What else? What else? You've got Scott Newhouse here saying, so bullish, literally can't lose in the stock market right now. Red hot jobs data and companies beating. Yeah, that doesn't sound sustainable. But then again, sometimes it can be. It's wild. So we'll see. Then what else here? 205 strong resistance for Tesla, really? Let's take a look at that. I don't know if that's the case. All the events I go to lately are virtual, and it's been frustrating. I can watch educational videos all day, but I want to go somewhere in person. Bring in person back. You gotta have like a big event. You know, it's got to be like a 3-day event or something. You know, something good. I don't know. Anyway, yeah, Tesla is actually getting rejected there at that 205. So not wrong about your observation there. You've got NVIDIA knocking on the door of 800. Remember, we usually have about a resistance at about that 805 level for NVIDIA. And so you're getting a little bit of either some profit taken or some money off the table off some of these plays here. We'll see if that continues. 63.5 of BTC. First red candle there of the day on ARM. Yeah, Snowflake's trying to recover. Getting some green over there. A little bit of lag on that screen, the way that showed up. Costco hits 750, earnings in about 8 days. Apple jumps off of a 181 back up to about 182. Any other gargantuan movers here? Pan W, we can look at that. Let's see here. Look at the, oh wow, Enphase up 6.2%. Yeah, on that inflation read, that certainly should help. So Pan W. Thing about Enphase is, you know, you'll have a market here that tries to pre-price in the move down in interest rates, and I think one of the greatest signals of that will be when the Fed actually finally starts cutting. So good old wait and see. Ooh. Okay. Apple's iPhone steeply discounted in China on weak demand. Wow, really? Let's take a peek here. Apple's resellers in China are slashing the price of the iPhone 15 by as much as $180, signaling an unusually prolonged slump in demand. Wow, steep drop from the roughly $120 discount the company has offered on its smartphone lineup at the same time last year. Deflation is beginning, my friends. Deflation. It is coming. Enphase CEO buying. Well, remember, they have talked a lot about doing buybacks over at Enphase, so that wouldn't surprise me. Is SMCI running? The volatility of this one's been wild. Oh, wow, 8%. Holy schmokas. It's been such a little volatile mover here, but boy, it likes to move heavy in one direction. That's wild. Duolingo is still sitting on that 20% gain with AMD up 3%. Lemonade's up 5%. Hey, have I mentioned you can get life insurance in as little as 5 minutes? Paid promotion. Go to metkevin.com/life. That's the one Lauren and I use. And you can Apple and Android pay for it. Boy, it's been a while, I feel like, since I've said that. I love that. That was so freaking easy. Yeah. It's true when they say as little as 5 minutes. I actually think it's generous. I think for me it took like 80 seconds. Okay. Let's see here. Oh, there's some comment here on the DOJ commission proposal. Let's see here. There's a thought of a proposal here, rather, that the DOJ is suggesting sellers should no longer pay commissions to buyers' agents. Okay, that's fine. We already saw the lawsuit on that. Prohibit sellers from making commission offers to buyers brokers at all. Oh, that would be a game changer. See, like, what actually happened in the last lawsuit, I don't think is that much of a game changer, because, you know, people are just kind of going to keep doing what they've been doing, which is, you know, offering buyer broker commissions. But if they actually make it illegal, ooh, that would be a game changer. It would be good for buyer's agents, that's for sure. But I mean, that's the obvious take. I'd be more curious to see what it does for prices, because usually that's built in. And so that if people don't have a buyer's agent commission, maybe that allows them to pay more. But does it allow the seller to be willing to sell for less? Oh, that is very interesting. No, because the buyer might have to pay more if they want an agent. So then it costs the buyer more, but the seller's willing to pay for less. So if you still have the commission, the shift of the buyer, who's paying for it, the buyer versus the seller, seller's able to sell for a little less, but that costs the buyer more, so buyer has to buy for a little less, could actually lower home prices. If you just cut out the buyer's agent altogether, does it potentially allow, well, what does it allow? Again, sellers to sell for a little less. You know, supply and demand is going to really have to dictate what ends up happening to prices. I don't think you could really say with any kind of degree of certainty what direction you're going to go with pricing in real estate just because of that lawsuit. So there we go. Okay. But that's a good question. So I see your comments here, and I recognize that that's going to be interesting. I always like to say when it comes to these laws, just let me know when something actually happens, when something actually becomes law and survives lawsuits and all the nonsense. Like, tell me when the rules actually change, and then we'll adapt. Yeah, because speculating about all these, like, oh, what if they do this? What if they do this? It's so freaking exhausting. I say the same thing with Lauren, too. She gets mad at me sometimes over it. So, in fairness, I understand sometimes it makes sense to plan. But many, many times, I'll be like, oh my gosh, well, okay, what are we going to do if this happens? What if this happens? What if this happens? And I'm like, here's what I'm going to do. Not worry about any of that until it happens. No, and I realize there are times, like, you should plan. It's kind of like if you're flying a plane, okay, what are we going to do if the engine blows out? Well, you should have a plan for a case like that. But sometimes, and you kind of have to pick which ones are most important, sometimes you just put yourself in a dither. When none of those things really matter, like it's not like going to be, it's like you're going to crash a plane. Sometimes I feel like over planning it just creates too much stress and distraction for people, where then they end up creating too much anxiety for something unnecessary. So you kind of have to debate, because sometimes, of course, it makes sense to plan for those contingencies. But when it comes to, like, are we going to have rent control or not? I'm not going to sit here and really care until it actually happens, unless I have to vote. If I have to vote, then I think it's worth speculating. But something like this DOJ or the lawsuit stuff, just let me know when the wind changes directions, and then I'll change, the way I need to adapt. Because otherwise you just create so much anxiety. Okay, so let's see if there's anything else. Over-planning paralysis. That's an interesting one. Let's see. If you cut out the buyer's agent, then you have dual agency. No, that's not necessarily true. You could have no representation. What if a person wants multi-representation or not to work with a firm that's selling a home? Yeah, well, they could do that. You like a buyer themselves does not necessarily need an agent to represent them. You could go into it, like, there are plenty of deals where even though we're licensed, we just say, we don't need you to represent us, and we'll just pay no commission with House Hack, for example. And so, in theory, because I'm licensed, it's kind of like representing ourselves. But if we were unlicensed, we could basically just be like, just don't pay a commission. We'll represent ourselves. Tell us where to sign. Like, you can treat it like educated adults. So now I don't necessarily think it's great, because I think most home buyers are quite, even multifamily buyers, are quite emotional, and deals take a lot of massaging to actually stay together. But, oh well, be really interesting. I wonder if it'll increase the cancellation rate. See, that I think would be more interesting. Would you actually see the cancellation rate of real estate skyrocket because of it? That would be fascinating. Super microcomputer gives up some of its rally. You've got the Q's giving up a little bit as well. There we go. I'll load that red candle in. So sitting about 73 bips. Let's see some of these other comments you have here. Let's see here. That will happen. What will happen is buyers will need to have access to wrap their commission with a loan. Well, yeah, you can do that. You would just ask for credit backs, right? Or it would be smart to pick up representation. Yeah, I also agree with that. Most buyers are uneducated in real estate and should have representation. I do agree with that. So I do think that's going to hurt buyers. How bullish do you think Enphase CEO open market buying is? I think it's designed to be a signal. I don't, you know, they've been talking about doing buybacks for a while. Apple may be feeling the effects of the Samsung S24 Ultra being so good. Is that the one you have, Ozzy? Michelle Obama versus Trump. You know, that's still in the Vegas betting odds. I don't know if that's actually going to end up happening. All right, Mr. Spam Coiner here. We're going to delete that person for being a spam bot. Is censoring a spam bot censorship? Or is it just cleaning up a loser? I don't know. Okay, good questions here. So we're gonna jump over to the course member live. Let me just see quickly if there's any last minute update here. Bond gains likely. We looked at that. That's fine. I need another cup of coffee. We've got bonds at 4.246, slow trend down there on maybe that bond buy rebalancing that there's some expectation of. We'll see if that continues. And yeah, I guess I'll. Oh yeah, tomorrow's Friday. Oh, why did I think today was Friday? Today's Thursday. How interesting. Oh, well, yeah, good thing. Tomorrow, dude, tomorrow's gonna suck. I have to be all over. I think I have like 5 flights tomorrow. Oh well. Even though I'm a licensed financial advisor, real estate broker, and becoming a stockbroker, this video is neither personalized financial advice nor real estate advice for you. It is not tax, legal, or otherwise personalized advice tailored to you. This video provides generalized perspective, information, and commentary. Any third-party content I show should not be deemed endorsed by me. This video is not and shall never be deemed reasonably sufficient information for the purpose of evaluating a security or investment decision. Any links or promoted products are either paid affiliations or products or services which we may benefit from. I personally operate and actively manage the ETF and hold long positions in various securities, potentially including those mentioned in this video. However, I have no relationship to any issuers other than HouseHack, nor am I presently acting as a market maker. This Celsius rally is crazy. They were negative pre-market. Jonathan here says sellers won't take unrepresented offers seriously. That is very possible because you know what'll end up happening is the dual agent will just have to. You know what? Here's your speculation. I think people are gonna come in and gonna be like, "Yeah, I want to make an offer," and then the listing agent's gonna be like, "Bro, how are you gonna make an offer? You don't even know how to fill out the paperwork." They'll just be like, "I'll just write it for you," and then what you'll probably have is you'll just have a lot more dual agents where they'll just like, "Look, I won't charge you anything. I'll the seller will just pay me a few more bucks and they'll get like, a little bit more of a bump commission for just being dual agent, and it'll make the buyer feel like they didn't pay a commission, they got a good deal or whatever." That's probably what you're going to see is a lot more dual agency. I don't see a buyer putting together a contract themselves. So that's an interesting point. Anyway, thanks folks. Bye.